Prasanna. They backed over 110 or helped over 110 SaaS companies. They've written checks into 47. They put a $100,000 check in exchange for 5% of the business. That company they can then go raise another equity round, and then they don't have to pay back any capital. Or if they want to say, you know what, I don't need more money, that founder will then is required to start paying back at 1 year between 3 and 7% of their monthly revenues, paying back a 3x cap on the 100K investment from Prasanna to buy back 4% of the equity. Apeka will still keep 1 for that long road. Hey, folks, my guest today is Prasanna. He's with a group called Apeka based out of Bangalore. They're helping B2B SaaS startups grow faster, and he's a very humble guy from that intro. They're really behind some of the fastest growing startups in India, and India really right now is a hotbed of some of the smartest founders, whether that's Saravana, the old Netcore crew, the Freshworks crew, you name it, they're in India. Something special is happening. So we're very privileged to have Prasanna on the show today. Prasanna, are you ready to take us to the top?
Absolutely.
All right. Why am I seeing SaaS founders coming out of India that they just seem to be, all of them are like 10 million bucks in revenue bootstrapped? It's like, what's going on in India?
Yeah, I think it's something in the water here, right? The analogy that I give everybody is that, in 1992, there were 200 IT services companies doing $100 million of exports. And in 2002, there were 8,000 IT services companies doing $12 billion of IT services exports. So it's the same thing that's happening right now with SaaS. The things that we're good at in India are, we have a lot of developers. There are probably 1 million or more developers just in Bangalore. So if I throw a stone outside, I'm more likely to hit a software developer than a crow, right? And we know English, so we can make software for folks who are speaking English, right? And I think the last word in SaaS is service. And so if anybody wants to implement a SaaS product, if they're mid-market or an enterprise customer, they need integrations, they need migrations, they need training, they need data transformation, all of that stuff. And most of that stuff, you can't just do it off the shelf, right? There has to be somebody who looks at your data, how that data has to look in the system, and figure out how to get it there, right? So when you put all these things together, I think, and the water, it all starts working.
It's amazing. I remember one of our first conversations. I forget if it was with you or the crew there at Apeka, but it was November 2021, and you guys said, Nathan, we're really targeting 60 startups at 100K checks each in 2022. We've now finished 2022. How'd you guys do? How many startups did you help?
So we worked with about 40 startups, and I think we did a total of 47 or 48 checks.
Wow. Okay. 100K. And is it always 100K?
Yeah.
Okay. So walk me through that model. Folks might be listening going, wait, what's the investment model here? Is it like YC? Is it like NDVC? What's it like?
Right. So the 100K is NDVC.
And so explain, right? Some folks don't know what that is, right? So explain what a BDC is.
Sure. Right. Yeah. So what we want is for founders to be in control of their destiny. So we want to make sure that we're able to work with founders, not only founders who are expecting to get a hyperscale kind of an outcome, but we also want to be working with founders who want to be founder forever or who want to take a strategic exit, right? So what that means is we don't want to lock them into chasing funding every 18 months. We want to make sure that, hey, if you're building a business, if you can get to 5 million and you're cash flow positive and you're making, let's say, 2 million net, then you can return money to us at a good multiple. Yeah, it's a great business, right?
Yeah.
So I literally have one of our first cohort startups. I won't tell you who, but they're at 6 million in ARR, and they have 2.5 million in cash in the bank every year. Right?
That's incredible.
And they don't want to raise money. They don't want to get into the rat race, and they're growing 50% year on year.
Well, so how do you guys make money, right? Most VC firms will say, listen, we're writing 100K checks. We need 1 or 2 to return the fund and become a $1 billion company. So when you say the fund, the money you invested, 47 checks at 100K a pop, so 5 million deployed in 2022 is a BDC. What do you mean by that? What's your return profile?
Right. So out of the first 10 startups that we worked with, Nathan, we now have 6 startups over $1 million in ARR. Out of that 6, there are 3 that have crossed a $5 million ARR. Right. Mm-hmm. So think about this from a fund perspective, right? We are investing in something like a 2.5 million kind of a valuation. If they get to a 5 million, and even in today's time, let's say they're at a 5x kind of a multiple, they're at a 25 million valuation, right? So we have a 10x in a valuation jump in about 30% of our companies.
Mm-hmm.
So that takes care of a lot of the return.
But
And then another,
culturally, these are founders that don't want to exit, right? They love cash flow. They're
yes,
not searching for growth at all costs. So how do you
right,
actually turn those paper gains into real yield? Or do you not need to do
two
that
ways,
because this is a BDC?
right? So two ways, right? One is, so we are not like we are not holding that equity forever, if that's the question, right? We do have to return. And the two ways that we return is, one, if they are never raising any capital, then they can buy back just like in the Indie VC model, right? Number two, we are finding that there are funds now who are coming in and saying, hey, we'll just pick up secondaries from these founders or from us, right? And they're not looking at a primary infusion or a small primary infusion. And they would love to pick up equity in a SaaS company that's actually profitable and growing.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time, you can see what it changed over the past 88 days, and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here, and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. I mean, are you seeing Sequoia in India, Excel in India? Are they approaching you and saying, hey, we'd love to buy out that 5% you own in that $5 million SaaS company?
No, not yet, right? Because they are more in the traditional model of, hey, show me $1 billion TAM, show me how you can get to $1 billion IPO and stuff like that. But there are so many search firms and so many Ps and mini Ps in the US who are now like, if it's a SaaS company, they're like throwing an email at it. And all of our founders who cross a certain level, they have like an email a week in their inbox saying, hey, can we talk to you?
Yep. Now, you mentioned there's 2 ways to return. Buying the secondaries, which you just described. You said, but the first was founders can buy back the equity. Now, do they have the option to buy it back, or are they forced to buy it back at a certain time level?
Right. So the Indie VC, we are using the straight Indie VC term sheet, the exact same thing, right? So in that, the founders, if they do not raise any further capital, they start buying back with a percentage of their revenue every month or every quarter. After
if they don't raise equity in what a period of when does that buyback have to start? 1 year, 2 years, more 3
2
years?
years, 1 year, yeah, one year plus, right? But it's on a month-on-month basis. It's not all at once.
So if you wrote a check into Nathan SaaS Company Inc.com today for 100K, and I grow to $1 million run rate in a year, I am forced, once I hit a year, I am forced at a year to start paying and buying back Upeka equity.
Right.
At what multiple?
Portion of your revenue, 3x.
Okay, so if you put in a 100K check for, you said 5% is pretty typical?
Yeah.
can I buy back? Am I forced to buy back your entire 5% portion, or do you hold 1%?
4%.
Okay. Yeah. So
It's the
I would
same
need to,
model.
it's the same
Exact
model as
same.
NDVC. The reason I'm asking those, there's a reason NDVC shut down.
Yeah, of
Right.
course.
So I'm
Sure.
trying to see if you've made edits on the model that you think will be more sustainable for both investors and the founders, because one of the big negatives was that founders don't want to pay back $300,000 on a $100,000 investment starting, and they're forced to do it starting at 1 year. Have you built anything into your contracts to give founders more flexibility, more control?
Yeah. We are looking at doing that, right? So we do want to give founders more optionality in terms of choosing to do that buyback, right? So if we can delay the payments, we can prorate the payments, do stuff like that.
Is there ever a world where you wouldn't force the founders to pay it back? Because I mean, this is effectively, in my opinion, really expensive debt, right? It's $100,000 up front, and then you're going to make 300,000 on it over a 3-year period. That's pretty darn expensive when you do an effective interest rate.
Sure, but when they're coming to us, they're not coming to us at the level that you are getting them in, which is at a 20K MRR or a 50K MRR. They're coming to us at practically no revenue, right?
Yep.
So when they're coming to us at no revenue, then equity is the only risk capital that they can get, because they can't get debt capital that you provide, because they don't have any revenue yet.
Yep.
Right. So then what choice is there, right? Because we are also taking a risk, because as you well know, for somebody to go from a 10K MRR to a 30K MRR is a different risk profile. For somebody to go from a 30K MRR to a 80K MRR is a different risk profile. For somebody to go from a 1K MRR to a 30K MRR is a very, very, very different risk profile, right?
Yeah.
So we are on the early end of that risk profile. I think you are a little later on the and little bit ahead of us on the risk profile. So we'd love for our startups to then come to you and say, hey, you look, we now have revenue, we now have customers, the revenue is good quality, we have good margins. Can we take more money from you, right? Because many of our founders,
we just don't get any equity. That's the problem, right? We're boring. Sure. We're boring, non-dilutive debt, right? Yeah, you will always have 1% equity no matter what. But right. I get your point. You're coming in much earlier than we are, and there's more risk for you. So I understand that.
Right. And we also do a lot of hand-holding in terms of getting them their first customers. We're working with them to change their positioning, change their website, change how they talk to customers. We literally
and you have an incredible community too. I mean, you look at who's on stage at SaaS Boomi, you look at your website and the partners you're bringing in, you have really an incredible network you've built around these founders, which is what helps them get to $1 million, $3 million, $5 million in ARR. Right. What is the percent of monthly revenues that they have to start paying back after year one?
Right. So that's between 5 to 7%.
Between 5 and 7% per month.
That's
until a 3x cap is paid back.
Yes.
Okay. What if that takes a founder 20 years? Like, is it all due at some point, or could it take them 20 years?
No. Yeah. It's okay.
I see. Okay. So there's no recourse. In other words, if a company goes bankrupt or they can't pay you, there's no way. You just keep your 5%.
There's
equity.
Nothing. Yeah.
Well, there's nothing. You just keep your equity.
Yeah.
Yeah.
I mean, there's no recourse is what I meant.
Yeah. It's find it fascinating because that's reversed whatever everyone else says. It doubled, tripled down on your winners, but your winners, you're forcing them to pay you back. So it's jamming down your equity, and that's where your big returns are going to come from. You're okay with that, though?
I think you're modeling this as a single turn game versus we model it as a multi-turn game. So what happens is that in our winners, right, they're typically raising more capital, so it gets converted into equity. Does that make sense?
Somebody who's winning in your portfolio has the cash flows per month to pay you back, and they can pay $300K, 3x cap to buy back 4%.
But what they do essentially is raise more capital, right? Because the folks who are really growing way beyond expectation, right? They actually want to raise some capital, and when they raise capital, we stay on as equity. Did that make sense? So the top 1% of our companies.
So you delete the part of your initial contract that says they have to start paying you back at 1 year if they go raise a bunch of equity.
That's right. It's the same. NDVC has the same model actually.
Well, again, but NDVC is dead.
If they raise capital.
There's a reason Bryce shut NDVC
Bryce
down.
is restarting.
Well, in a pretty different format, right? If you interview some of the LPs in that fund and you interview some of the founders, there just was not alignment there. I just want to make sure I understand you correctly, though. If somebody raises money from you today and then they grow to $1 million a year run rate, and in a year they go raise a bunch of equity, they are forced to keep
then we
in the
stay as equity.
5%. But is that your choice or their choice? Because are they forced to keep your 5% equity?
Yes.
Oh, they can't pay you
it's
back.
like if there is a convertible debt for 100K. That's right.
Oh, I see. Interesting. Very interesting. Okay, and these are all B2B SaaS,
So
right?
think of the top 2%. Yeah, they're only B2B SaaS, right? So think of the top 2% of companies. They're going to hit $1 million and then raise 2 million or 3 million or whatever it is, right? And so those folks we will stay as equity.
Yeah, you're either staying as equity if they decide to raise, or if they don't raise, they're forced to start paying you back after 1 year, 3 to 7% of their monthly revenues.
That's right.
Interesting. So I thought you guys were really representing that founder that wants to bootstrap and not raise, right? Not give up equity and go to 5 million in revenue and profit 2 million a year and build a great business. That sounds to me though like that kind of founder would not be a good fit for you, because they'd be forced to either raise money to get rid of the payback, or they'd be forced to start paying you back at 1 year.
I mean, if you're taking money, I'm assuming, Nathan, that when you give money out to people, you want a return too. The terms are the terms, right? So we are saying,
well, no, we get no equity. We take no equity, right?
That's fine,
our
right?
our whole model is we want to support founders that understand that giving up equity can be a big detriment to the business for a variety of ways.
Right. And if you talk to any of our founders, and if even a single one of our founders tells you that giving equity to Upeka and having Upeka as a partner in their long-term journey was not a good thing, then we change our terms. But that's not the case. The kind of support that we're providing to our founders, they can't get anywhere in India, and maybe not even anywhere in the US, right? Because we are taking founders who have sold only in India, who never even gone outside of India. We are helping them build a business that's global and get revenue that's global. So for many of them, it's literally, we are a partner who's helping them do things that they cannot do before. We're not dumb money, right? We're literally hand-holding them to change their website, the language on their website to sound more global, for example, right? So those are the kind of things which I believe, right? And you can correct me if you think otherwise. We're literally changing the DNA of the business, right? So we have folks who have India revenue but have struggled to get global revenue, and we are helping them make that first dollar of global revenue. Is that worth equity, or is that not worth equity, right? I think that's the question that founders need to ask themselves, right? So I have folks who have built services business. They've tried to build product businesses, and they've struggled to build product businesses, because when you're trying to build a product business, you need to make different decisions than when you're building a services business. And so somebody has to literally sit with them and tell them, look, this is how you're making decisions. And this decision was okay in a services business, but this decision is not okay in a product business. And you need to rethink how you do that. You may have made the wrong hire, because the person you hired as a developer in a services business, that was okay, but that same person is functioning in a product business in a way that is detrimental to the long-term health of that product business, right? So that's the granularity at which we work with founders and to transform their business, right? So when I'm helping folks,
you sound much more like a venture studio. When I bring on folks that are building venture studios like Turtle, which popped out with Phil Libin, you sound way more like a studio than you do a VC fund.
Right. So we spend literally, dozens to almost 100 hours per founder from me and my team, right? To help them cross that kind of an initial.
And when just put this all on a timeline for us, because folks might be new, they might be learning about you for the first time here on the show. When did you guys write your first check? What year?
Just 1.5 years ago. So 2021 is when we wrote our first check.
Okay, 2021.
So before that, we were only an accelerator. We were only helping folks with actually building the business. So only once we proved out that we could help folks to build a business without any capital, we said some of the startups need some capital at the early stage, because otherwise everybody is working on fumes, because they're getting some revenue, coming back, spending it, getting some revenue, coming back, spending it. Then we decided to add a layer of capital after we proved that, yes, we can take startups that are at near zero, help them get to scale, right? So as an example, right, one of the startups that came to us, they were at literally $1,500 MRR, $2,000 MRR. Today, they're at $60,000 MRR, right? And if you talk to them, their website, their copy, their emails, their marketing strategies, their positioning, what features are in the product, what they're selling, the values, all of that was stuff that they worked with us.
That makes sense. I understand. So the first check was in 2021. You already told us numbers from 2022. What are you guys targeting in 2023?
This year, we are hoping to write about 60 checks.
Okay, 60 checks. Interesting. And all still India focused.
So almost all our startups are selling globally. They may be headquartered in Delaware or they may be headquartered in India, but most of them are actually Delaware headquarters with subsidiary in India.
Okay, great. And remind us again, sorry, your guys' source of capital. Obviously, you and I both have to raise money to then give out to founders, right? Where are you raising money from?
So most of our investors are actually SaaS founders.
Yep.
And we have one large anchor LP called Westbridge.
Okay, very cool. And did you raise a new fund last year, or are you still operating out of Fund 1 from back in 2021?
This is a rolling fund.
Okay.
This is an AngelList rolling fund. So that's the model that we're still on.
And how do you those investors, how do you pay them out? Is it a fixed like payment every 3 months, or do they wait until like it's like DPI, like a regular VC firm?
Yeah.
They wait for exits. Yeah. Okay, so they don't get any, like when founders have to start paying you back at 1 year, you don't distribute any of that money back to
we
LPs.
Can, but we don't need to.
Oh, I see. So you can reinvest into new checks, the 60 you want to do this year.
That's right.
I see. Any exits so far?
We've had 4 exits so far. Most of them have been strategic acquirers, not too large.
Okay. But you've got a couple you're excited about that you think can more than return the fund, huh?
I think so, because one of them just doubled last year with very little capital raise. Actually, 3 of them, like I said, right, 3 of them crossed $5 million in ARR. Out of that, 2 of them have not raised a single dollar. We are the only outside equity holder, right?
We have another and sorry, 3 out of how many? How many total portfolio companies today?
So we have a total of 110 companies, but I would only look at the first 20 companies because that's the ones that have been around for 3 years, right? Because the others are like last year and the year.
But you've written checks into 110 companies since you started, SaaS companies.
No, that's the accelerator.
Okay, how many have you written a 100K check into?
About 47.
47. Okay, interesting. Well, we're rooting for you, Prasanna. If people want to learn more about this, where can they find you?
Upeka.io, and I'm very active on LinkedIn and Twitter.
Guys, that's UPEKKHA.io. And Prasanna, what are the next 2 events you're going to if people want to meet you in person?
We'll be doing our own events, so we'll be putting that on Twitter. I'll also be at SaaS Boomi in March.
SaaS Boomi in March. And what city is that in?
That's in Chennai.
Guys, there you have it. Prasanna, they backed over 110 or helped over 110 SaaS companies. They've written checks into 47. They put a $100,000 check in exchange for 5% of the business. That company, they can then go raise another equity round, and then they don't have to pay back any capital. Or if they want to say, you know what, I don't need more money, that founder will then is required to start paying back at 1 year between 3 and 7% of their monthly revenues, paying back a 3x cap on the 100K investment from Prasanna to buy back 4% of the equity. Upeka will still keep 1 for that long road with the founder. Prasanna, thanks for taking us to the top.
Thanks, Nathan.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers. They try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.